Okay, now settle down, please. Thank you, councillors. And so today we have a very important workshop about the 2024-25 annual report. This is sort of the final bookend to the 24-25 year. And so we're going to have a run through of find out how we did, basically. Look, thank you very much for all the work you've done. I know that the effort to try and get this through before the election has been a major, and we're running a little bit late, but we are going to get there hopefully in the end. And hopefully at the end you can run through the whole thing. That's what I'd like you to do. And at the end of that, questions will be taken at the end. Yes, Councillor Young.
Is this being live streamed?
Yes, this is being live streamed. Okay, thank you. So over to you. Thank you.
Thanks. All right, kia ora everyone. Welcome to this briefing for the Volume 2 of the annual report, which is focusing on the Council's financial statements for the 12 months to 30 June 2025. Presenting today will predominantly be myself and Dean Norton, and we also have some cameo appearances by Sarah, our Treasurer, and Rana on a couple of slides. So for those who don't know me, I'm Karina Young, the Financial Controller, and we have Dean Norton as well, who's our Financial Accounting Manager. It's Dean and the financial accounting team who are our accounting standards experts, and it's his team that have done the hard yards pulling together the financial statements. So we'll be taking it in turns between us to talk through the 20-odd slides we have today. We do have a fair bit to cover. All right. Excellent. So,
Sorry, just also jump in. Sorry, just for people. So I'm Tony Randall. I'm Deputy Chair, and Bruce Robinson's unable to make it today, but he is online, and hopefully you'll have a couple of questions as well. So welcome, Bruce.
Absolutely.
And
thank you, Tony, and thank you for deputising.
And our other online councillors are appreciated as well. Thank you. So go for it.
Excellent. So this slide's just covering the agenda. So as I mentioned, there is a lot to cover today. I'm going to outline, I guess, the purpose of this presentation, recap the previous meetings to date to lead us to where we are now. We'll provide an overview of the draft headline results, so the main financial statements. Also, we'll talk through the new accounting standards and accounting policy changes that are within this document and the areas of key estimates and judgments, which includes revaluations and provisions for other liabilities. We'll also talk through contingent liabilities, the events after the end of the reporting period, and as mentioned, there'll be time at the end for any questions. All right, so moving on to the purpose of the presentation. This year we've moved the timing of this briefing actually to be near the end of the annual report process. So the full draft financial statements have now been made available to you as part of the agenda pack for this Thursday's Audit and Risk Committee meeting. In terms of the annual report process, the role of the Audit and Risk Committee is to review and monitor the integrity of the annual report. This includes the statutory financial statements, focusing particularly on compliance with accounting and legal requirements, consistency of applications of accounting policies across reporting periods, agreeing the accounting policies and practices, including any changes that may affect the way the accounts are presented, and any decisions involving significant judgments, estimates, or uncertainty. The review of these items then allow the Audit and Risk Committee to make a recommendation to the Long-Term Plan Finance and Performance Committee as to whether that committee should recommend the Council to adopt the annual report. We appreciate that the financial statements that we require of our ARC members to review and then ultimately the Council to review are actually a technical accounting document. Although we've tried to make them as plain English as much as possible, the reality is because of the accounting standards that they must comply with, there will always be an inherent technical nature to them. So the purpose of this briefing is to help guide you through the 130 odd pages of the financial statements, providing you with an overview of the headline draft financial results and the key areas of change from last year or where there have been significant judgments or estimates used. This presentation is going to focus on the Council's result and not the group. And so the Council figures include our joint operations with Porirua City Council for the Spicer landfill and the Porirua wastewater treatment plant. All right. Right, the last slide on kind of setting the scene. So this is just a recap of the previous meetings we've had to date. So this kind of kicked off for the Audit and Risk Committee back in May. Dean presented on the pro forma financial statements to the Audit and Risk Committee. Those pro forma financial statements acts as a template which outline the format of the financial statements and the disclosures for this year. One of the key changes we put through those pro formas was actually grouping all those primary financial statements like the P&L and the balance sheet at the front of the document. In the past, they used to be in the relevant section. And so from that, we took on board any feedback and have fed that through the process. In June and the start of July, the pre-final audit started for Audit New Zealand, where they predominantly focused on the revaluations, which was different in the past, which is great because it meant that they could clear that a lot earlier than in the past. On the 18th of August, the on-site audit commenced, and then on the 26th of August, we had a Volume 1 workshop on the front half of the financial statements that was presented by Jocelyn and Baz, seeking your feedback on that. And we also presented at the early September Audit and Risk Committee an update on where we're at the financial statements. So that brings us to where we are at today. I'm just going to do a quick overview of the current status of the draft financial statements. So, as mentioned, they were included in the agenda that went out last week for this Thursday's meeting. They are our most up-to-date set and they incorporate all the known changes we know of. This will be pending the outcome as we move closer towards audit clearance and any further feedback from the Audit and Risk Committee meeting on Thursday. The financial statements have been prepared predominantly by the financial accounting team and have been thoroughly reviewed by various council officers, and they've been audited by Audit New Zealand on behalf of the Auditor General. The financial statements contain disclosures required by financial reporting standards, the Local Government Financial Reporting and Prudence Regulations, and the Local Government Act. There have been no significant changes to the format or proposed disclosures of the pro forma financial statements that we presented back in May, or anything that we've updated you on in early September. There's one exception, which is the proposed new asset class we'd put through the pro formas to note 18, the intangibles, and we will come to that in a future slide. The on-site audit concluded last Friday. However, there's still some residual work that remains for Audit New Zealand to complete their files, and they are nearing the final stages of what they call the EQR, the Engagement Quality Review. And we've provided on the financial statements, we've provided answers to all their queries, and we understand they're still on track to provide verbal clearance late this Wednesday and prior to Thursday's meeting. So in terms of the group position, we have received representation letters from all group entities with no significant matters raised. The majority of group entities have now either received audit clearance or adopted their financial statements. There are a few exceptions, which are mainly due to audit timing. However, their results will not be material to our group result. And we also understand Wellington Water Limited were approving their annual report late last Friday. Whilst the financial statements are still to be adopted, we will continue to monitor for any new information that comes to light that may require a change to our current disclosures, particularly around contingent liabilities or events after the end of the reporting period, and that's a standard process that will happen every year until you actually sign the accounts. Right, I think that's enough from me. I'm going to pass it over to Dean.
Thank you, Karina. So this slide shows our headline financial operating results for 24-25 compared to the annual plan budget. So for the purposes of the annual report, all the budgeted numbers are from year one of the 24 to 34 LTP, which was adopted June 2024. It doesn't include any subsequent adjustments or revisions to budget. So the reported net surplus is 62 million compared to a budget of 81, difference of 19. The full statement of comprehensive revenue and expense is on page 272 of the agenda pack. And I'll cover some of the items that are on kind of what is below the line on that slide. Overall, we've got a 224 million sort of other comprehensive expense this year, which is actually largely driven by the revaluation of our roading assets, and Karina will talk about the revaluation in a bit. The other thing I kind of mention in this slide should be familiar to you, but just as a reminder, the reported surplus does include quite a lot of capital revenue for which there are no corresponding kind of expenses in this year. So it's not like we're making lots of money. It's an accounting profit. Just wanted to flag that one again. On the next slide, so this one gives a little bit more detail about the actual sort of unders and overs compared to budget. As can be seen from like the top table, overall revenue was slightly higher than budget by about 17 million, and expenses were higher than budget as well by about 36 million. The second table just breaks those differences down into their component parts. So you can see that we've seen like reduced capital funding from Waka Kotahi compared to budget of about $20 million, but that's partly offset by recognising the vested asset and other revenue budget or other revenue income of around 13 million. We don't budget for the vested assets and sort of like gains and losses on disposal because you just don't know what they're going to be. The investment revenue is also higher than budget, and that's largely down to the dividend that we've got from Wellington Airport. Depreciation and amortization, that's $15 million, I guess, higher than budget, so increased cost. And that derives from the revaluations at the end of last year. The last thing there, well, two other things to cover. One is net finance expense. So that's effectively the net of interest revenue or interest expense less interest revenue. And that's 5 million different to budget or 5 million less than budget. And that's largely driven from reduced capital spend and the lower interest rates during the year. And then the last thing, which Karina mentioned earlier on, was around the expensing of the costs for the digitisation of property-related records. So that resulted in an extra 14 million of cost going through the profit and loss or the surplus this year. Below the line, so this is sort of old terminology. There are certain accounting rules that require certain like non-cash transactions and to be shown below the net surplus line. So those items generally reflect revaluations and movements in our cash flow hedge reserve. So within our other comprehensive revenue and expense statement, there is the revaluation loss from the roading assets, which I've sort of touched on, and also there's a $31 million paper loss on our cash flow hedge reserve. Both of those movements, I just want to sort of emphasize, you can kind of think as a kind of theoretical accounting entries because they're not cash and they actually don't get realized. It's the accounting rules that require, accounting measurement rules that require them to be disclosed there. So I'm now going to hand over to Karina to talk, or maybe Karina, possibly, to talk about capital spend. Maybe Rainer.
That would be me, thank you, Dean. So we do report to you throughout the year in terms of our quarterly report on our capital spend, but I guess just some highlights for the year. We did have a budget approved through the 24-34 long-term plan of $695 million for the 24-25 year. We spent $489 million, so we only achieved about 70%. Now, as you're well aware, there were some big drivers for that. That was the amendment to the long-term plan that put some of those projects on hold, and at the same time, the reduced funding from Waka Kotahi NZTA. So that kind of, I guess, delayed some of our capital projects starting and the uncertainty of whether or not they would be going ahead. So that's some of the driver for that. Back in June, through the deliberations of the LTP, we also brought to you a capital carry-forwards decision, and that was where we were forecasting to underspend in the current year, and I guess reflecting that through the next year's budget and the out year's budget. So that was about $160 million. So of the underspend for the current financial year, we moved $160 million out over the next few financial years to recognise that those projects were delayed. Karina touched before on the digitised asset write-off. So we had previously budgeted for capital expenditure relating to the digitisation of some of our archive records. We've since had, through the audit, advice that should not be capitalised and is in fact operating costs. So the annual report or the financial statements reflect that move of that capital expenditure to operating costs, and has, I guess, driven the costs higher, as Karina showed you through that table. $5 million of that is from the current financial year. Now, we do have funding for it in this financial year and also next financial year, and we will need to bring advice back to you in the new council, towards the end of the year around how we treat that, how we adjust for that, because there will be some funding implications that we need to consider as well. There's other information on those slides, but I think we'll move forward now and back over to you, Karina.
Excellent. Are you happy just to take questions at the end, or do you want to do them as we go?
I said we'd just take questions at the end, but if you want to take some questions now, then it's over to you. Or do you want to go through the whole thing?
We can go through it all, as long as people are okay from remembering all your questions.
Yes, sure. I'm keeping a list.
All right. So this slide is the summary of our financial position, or more informally referred to as our balance sheet. So you can see total assets have increased by $125 million from last year. This is largely driven by the increase in property, plant and equipment as a result of the capital program spend, offset by the revaluation loss on infrastructure assets and depreciation for the year. The total liabilities increased by $288 million from last year, and this is largely driven by our gross borrowings, and which is a nice segue over to Sarah and the next slide on borrowings.
Fun, that's me. Hi. So this is one of our financial prudential measures. It's the accounting speak for this is our debt to revenue calc, but under the accounting standards, as opposed to our LGFA covenants or any other way of looking at it. And this is a requirement for us to report on this each year. Probably quick headline there, you'll see it's moved from 187% last year to 188%. So year on year, only a 1% movement in the overall. The driving factor behind that is obviously an increase in debt, as Karina just suggested, and then a corresponding, not quite corresponding increase in revenue as well. So we're talking almost 300 mil of debt and around $100 million of revenue increase that's driving that tiny little step up year on year.
Back to me. So there haven't been any significant changes in accounting standards this year. There was one sort of amendment, which was around the disclosure of audit fees and auditors' remuneration. But the impact of that is actually quite small because we've previously disclosed quite a lot of information in reasonable detail around that area. As we sort of have talked about previously, there was one accounting policy change that we've included this year, which was around providing greater disclosure and transparency of our restricted funds and restricted reserves. So these disclosures were effectively to provide, more information to the users, to be more transparent, especially around like the targeted rates, so that ratepayers can actually see how much we have spent from the rates that we've collected, and that's more in line with lots of other councils across the country as well. Note 32, so the restricted funds note on page 355 of the agenda pack basically goes into the disclosures for those restricted funds. We've restated the prior year comparatives accordingly, but just a note that there has been no change to net assets or net equity as at the start of the year, because it is a presentational change. We are just providing greater granularity of disclosure rather than actually changing the underlying number. I'll do that.
So the next section we're moving on to is just other areas of key estimates and judgments. And the next few slides are going to talk through our revaluations. This year we undertook 3 full revaluations, and we've got one on each slide. So the first one is our investment properties, which is in note 19 of the financial statements. Investment properties are revalued every year by CBRE, and investment properties in accounting standards are properties which are held primarily to earn lease revenue or for capital growth, and as such, any changes in the revaluation actually goes to the net surplus and deficit, so what we were calling earlier the above the line number. It's important to note that during this year, the council approved 15 ground leases to be made available for sale. The carrying book value of those was $123 million at the time those council decisions were made. And as kind of required by the accounting standards, they actually then get transferred of note 19, the investment property class, and get moved into note 17, which is non-current assets classified as held for sale. So in this table, I've represented the 23-24 numbers just for the purpose of this table to take those out so you can see the actual revaluation result of the leases that are staying in the investment property asset class. So the council's investment property portfolio mainly comprises of ground leases, with the majority of them located within the CBD, plus certain land and buildings, namely the Embassy Picture Theatre, Victoria Street Car Park and the Tory Street Car Park building. So for this year, we recognised a revaluation gain of $7 million. And in terms of the balance sheet, the total investment property portfolio, including a little bit of work in progress, is $163 million now. Got the clicker and the microphone mixed up. So this next slide is our infrastructure land. So infrastructure land was last revalued in June 2022 by CBRE. So in line with our 3-year revaluation cycle, this has now come up for a full revaluation. So infrastructure land includes sites upon which the council's infrastructure assets are built, as well as vacant land. It includes land under some of the following asset types: reservoirs, pumping stations, drainage reserves, landfills, access ways, right-of-ways, isolation strips, blocking strips, and car parking. And some of the sites are in commercial zoned areas, but the majority are actually in residential areas all around Wellington. So this year's results was a gain of $8.1 million, recognised in other comprehensive revenue and expense. So that's the below the line section we were referring to earlier. So overall, residential and commercial land observed declines in their value, and this was marginally offset by an increase in industrial land values, resulting in an overall decrease of approximately 2% based on the existing assets we held since last revaluation. During this revaluation, we identified a lot of improvements to the data quality over the last 3 years. So we did recognise some additional land parcels, which were predominantly little isolation strips and access ways, like some really small parcels of land. And that's actually what's driven the revaluation increase of the 8 million. So the last revaluation we did is for one of our larger asset classes. This is the infrastructure assets, but excluding the 3 water assets managed by Wellington Water. So these ones were revalued at 30 June 2025 by WSP. It's predominantly our roading network, but it also includes some of the infrastructure assets at the zoo, the landfill, and on the waterfront. So the Council's accounting policy for revaluing infrastructure assets is to complete the full revaluation every 3 years, but in the intervening years we do a fair value assessment to ensure there's been no material movement since the last revaluation. So this year is year 3 of the cycle, so hence we've gone a full revaluation. So the result this year is actually a loss of 185 million, but to actually understand that result, we do need to talk about the full context since the previous revaluation in 2022. So last year when we did the fair value assessment in year 2 of the 3-year cycle, WSP undertook this for us, and that actually indicated a material increase in the value since June 2022. And so based on that indexation uplift that was applied to our asset values at 30 June 24, we actually had recognised a $250 million gain in last year's financial statements. And that uplift was primarily based on cost index increases to the unit rate cost for construction, and the fair value uplift didn't actually consider any changes to asset useful life, total useful life, or residual useful life. So it's important also to note those fair value assessments are just generally desktop exercises, and they're done at a summary asset type level, so they're not nowhere near to the degree of what the full revaluation is done at. So this year we've undertaken, as I mentioned, the full revaluation, which has now recognised a decrease of 185 million in the fair value. But if you compare it back to 30 June 2022, which is when we last did the full revaluation, it still is a increase on 2022. So it reflects, I guess, modest increases to the unit cost over those 3 years, but it's also offset by various changes to the assessed total and remaining useful lives. So like I mentioned, the full revaluation is considerably more detailed than what we did last year. And so the full revaluation includes, I guess, you're visiting this, a sample of site visits for the main asset groups. It takes into account the cost indices and also looks at recently completed contracts to get a good range of the cost. It's a full review of the total asset useful life, and it's done at a detailed line-by-line level, so you're also considering where actually these assets are. And also during the last 3 years, there have been significant improvements in the data quality, and that's what's mainly driven this result this year. So during that time, we've transitioned our database from RAMS to AMDS, along with lots of other councils who have been doing this. We've also had better information on the corrosivity based on the location of assets, so how far away they are from the coastline has now been taken into account when previously we didn't have the information to the level of detail we have now. There's also increased information on our half-cost assets. So those are obviously the ones where we, council has half the assets owned by council and the other half is by another party. In the previous revaluation, we only had that information for a small subset of assets. We now have that for a much wider group of assets. So the valuation reports completed by WSP are they're very detailed. It was about 100 odd pages, and our capital and project accounting team were heavily involved right from the start of the process, from the data that was sent to them, and we had several revisions of the draft results. So it was led out of the Kappa team, but we actually use our asset owners and the SMEs across council to review it for us as well, because they are closer to the assets and they did provide quite a lot of feedback back and forth. So we do think the result we've got is a very robust result. Also, WSP are very experienced in this area. They all presented earlier this year at the Taitoara Finance Forum alongside Audit New Zealand on how, like, best practices in the revaluation process. So we, and the auditors' feedback on those reval reports from WSP have been that they are good quality revaluations that they've undertaken. All right, it's still me. We're still talking PPE. This time it's the other asset classes that we didn't revalue. So just quickly, I think we've talked about it a bit in the early September Audit and Risk Committee meeting. Our other asset class we have in infrastructure assets is Three Waters. That was fully revalued last year. So this year we did a fair value assessment, and the outcome of that was there was no material change. So we haven't done any adjustments for that this year. But just to recap, at last year's Audit New Zealand did observe that the units rates used in the revaluation performed by WSP were above Audit New Zealand's developed audit range. And so as a result of that, in last year's independent auditor's report, they included an emphasis of matter over the uncertainty of the fair value of the Three Water assets. We anticipate that an emphasis of matter will likely be raised again in respect of the uncertainty of the fair value of the Three Water assets, and it will be referring readers to note 20 of our financial statements. Our other major asset classes, operational land and buildings. So again, we revalue that every 3 years unless there's been an indication there's been a change in fair value. We last revalued that in 2023, so this year is year 2 of our 3-yearly cycle. CBRE completed the fair value assessment for us, and it indicated there was no material change. So the current values we have in the financial statements are appropriate for financial reporting purposes, and next year for 30 June 2026 we will be undertaking a full revaluation, which will have to start very soon. And the other category we have is library books. They were last valued in 2023, so we're still not due yet to revalue with them, and they will be in the scheme of our full asset book immaterial. So we didn't complete a fair value assessment on those.
Okay, so another area where there's traditionally quite a lot of judgment is around provisions. So note 27 of the financial statements, or page 346 of the agenda, includes 2 main provisions. So we have one for landfill post-closure costs, and we also have one for the costs of settling weather-tight claims. For both of these, we've engaged external experts just to provide us with the required level of comfort around both the calculation and the quantum of those provisions. So looking first at the landfill post-closure, that's increased by 1.6 million, so now stands at just over $18 million. So whilst we operate stage 3 of the southern landfill, and we've also got a share in the Spicer landfill. There are around 35 sort of closed landfills, and we are required, like legally, to provide ongoing maintenance monitoring of those landfills, and so we have a provision for those costs. As I've, I guess, previously mentioned, that provision is quite judgmental in terms of how you calculate it, because it can go on for sort of 30 years post-closure. So there is quite a lot of subjectivity for things like interest rates, for discounts, discount rates, just for the estimated costs that we think are going to arise. So they are judgmental, but we do get them reviewed by AECOM which are external providers, and that does give us a degree of assurance over the quantum of those provisions. We also have a provision of just under $20 million for the cost of settling weathertight homes claims. So that provision, I guess, derives from the settlement of claims related to the Weathertight Homes Resolution Act, and also civil proceedings for weather tightness. So during the year, we paid just over $1 million in settlement claims, and we released a small amount, so 0.2 million from the opening balance, following the actuarial valuation, which should actually give some comfort that the valuation is actually reasonable as well, because that release is quite small. It is like the landfill; it's quite judgmental, and so we do get it independently reviewed. So that was reviewed by Melville Jessup Weaver, same as previous years. And I think the only other thing I'd mention there is that that provision is stated net of any costs that will be basically borne by other parties or expected to be borne by other parties, including insurance. Probably the final area of judgment, or significant judgment, relates to contingent liabilities. So they pretty much break down into two areas or two categories. So we've got quantified and then unquantified. So quantified is where we can effectively come up with a reasonable estimate of what that liability might be. The unquantified is where there's a lot more judgment in determining the nature or the quantum that will actually crystallize. Within the quantified section, we've got an uncalled liability of 1.9 million relating to the LGFA. That's the same as last year. And that derives from our shareholding, our guarantees as part of a shareholding council. It would only crystallise in the event that the LGFA is likely to default. So that's actually considered to be quite low, but it is a disclosure that we're required to make. The other amount that's included within quantified contingent liabilities is an amount of $1.3 million. And that's effectively an estimate of the liability that will arise from council decisions and also from legal claims that are outstanding. It's not a representation of sort of any guilt or anything like that. It's just an estimate of the likely outcome. We also have unquantified contingent liabilities, and probably the two that are significant, and these have been disclosed previously. The disclosures have been updated, but they relate to the same things. The first relates to risk pool. So that relates to effectively the liability that we had from the time that we were a member of the risk pool scheme a number of years ago. As most of you will know, that scheme is in wind down, so the risk is getting lower. There was a small call this year, or actually just post year end, that has been disclosed. It was only for 34K, so in terms of quantum, it's relatively small. But there is that risk there, so it is still disclosed. The other risk is for the structural defect claim, which you'll be aware of. We've tried to provide a little bit more disclosure this year around quantum to give users of the financial statements a better understanding of the potential risk. And we've also agreed that wording with our legal team to make sure that we're not saying anything that they don't want us to say. Those, as I think Karina mentioned right at the start, if there are any changes to that subsequent to sign-off, then we would update those disclosures, although we wouldn't expect there to be changes now. Events after the balance sheet date, I'll just get my screen up to date. The most significant one there is the disclosure around local water done well. We have worked with other councils to agree some sensible and consistent wording that gives the current status of the water services delivery plan. As you'll know, the plan got submitted. It's currently being reviewed. So the wording in the financial statements gives that disclosure. Again, if that changes, we will update the wording accordingly. But there are no other post-balance sheet event disclosures that we are aware of that would change the financial statements or the notes. It is really just a bit of an update on the water legislation.
So I was wondering if you'd mind me just stop there. I know you're nearly at the end, but I'm also conscious that some elected members have got questions about what we've got so far. So could we take them now, unless there's anything compelling in the next slide?
Yeah, can I just add a bit more context for the local water done well disclosure?
Sure.
Just a little piece. Since that agreement's still under review, what we have pointed to in that disclosure, I guess, because it hasn't been agreed to, there's still some uncertainty around how that's going to look for us in future. And because of that uncertainty, audit have indicated it will be a likely emphasis of matter in the audit opinion. And that's actually across the board for all councils in a similar situation to us, that, it's still changing and moving. So it will be uncertain until actual agreements are actually signed and we know how that actually looks for us for the future.
Okay, thank you. So I'll take some questions. First of all, from Councillor Young.
Okay, so I've got about 45.
Could you use your microphone, please?
It is. It's on. Oh.
Needs to be.
So I'm just interested in the figure for the digitize, whatever it's called, of the archive records, that it was 14 million out. Is that because it was a bigger project than anticipated, or what?
So this actually stems back from, I think it was 2021 that we've actually started digitising those records, and so it's been building up on work in progress on our balance sheet. So every year it's been budgeted for. Now, in 2022, there were new. The International Financial Reporting Council released kind of more guidance on software as a service, and this is not software as a service, but as part of doing that, they gave more guidance around intangible assets. So, and I'm not sure at council we've had that conversation around what that has meant, the change. It's not a change.
I just haven't got a clue what you mean by tangible assets. I mean, I know property is a tangible asset, but we're just talking about digitisation.
So I guess the non-physical assets, because it's a paper record that's now been digitised, we were thinking it would be an intangible asset, so not a physical asset. And so back in 2000, obviously they thought this would be a capital asset, an intangible asset, but the advice we've got now is that it's not, and part of that will be stemming back from 2022 when more guidance is released on how to apply that standard.
And that cost 14 million?
There's all the paper records that were held in paper.
It's been a significant project over the last
It's just, it seems like,
3 or 4
how many property
years.
records, you know how many records there are, so I would have thought you could actually gauge. I mean, not you, one.
Yes,
one,
yes.
You know. Okay, we'll move on to the next one. Could you just tell me, what is Waikuku? I know I've asked before and I can't
Our
remember.
staff accommodation move to Jarvis Quay.
Oh, I mean, is that our new building?
Yes, correct.
Oh, because it's also the building. It's the building in Bulcott Street. Because I looked it up. It's the whatever they are. Could you just tell me what is the difference between net and new external borrowings? No, it's a number 11 slide.
Is it the 283 million?
I've no idea. I've just written, what is the difference in net and new external borrowings?
So net borrowings is essentially our gross external borrowings less our cash and cash equivalents when you're talking to these guys, because they have a different categorisation for cash and cash equivalents largely. So you take everything we owe to our lenders and you take off everything, all the assets that we have that are reasonably liquid. For new borrowings, that's where Treasury comes in, and that's the new debt we have issued, so new pieces of debt to support our capital program. And it includes a little bit of CP, also.
So CP.
Sorry, commercial paper, so short-term debt. It also includes some pre-funding that we've done in anticipation of refinancing next year's debt.
But I mean, the guts of it is it's just all debt, right?
It's all the same, it's just how you look at it. So these guys look at it slightly different to how we do in Treasury. So
That's what you can tell
we're here
them.
talking about accounting standards today, so I'm towing the line.
Okay, I've got some
that's
more
okay.
questions with someone else. I mean,
Yes.
Geordie's busting to ask questions, I can tell.
Well, he hasn't actually got anything, but I do want to invite Councillor Brown for his
I just want to
questions.
shame them.
Thanks. Just actually one very small question, or two actually. So the CapEx table, which showed certain areas of underspend, Three Waters was shown to be actual 46 as opposed to budget of 62. Was that all the payment that was expected to have gone to Wellington Water Limited and did go to Wellington Water Limited, or was there some other item in there?
No, that will most likely be for Wellington Water. I do note, though, that the revised budget was 55 million. So as part of the decisions that were made in reforecasting and carrying forward budget, it was 55.
Yeah, they changed it, but once they decided they couldn't
But
spend
yes, all to Wellington Water.
it. I like the largest possible scale of gap with those guys to illustrate certain things about their competence. In the debt to revenue, the 188%, in terms of the revenue that goes into that calculation, I presume none of the crazy revenue like treating drawdowns under the sludge minimisation facility is treated as revenue. So it's all just, it is real revenue.
It's the real revenue. The numbers are around 770 million for last year and 880 million as opposed to what's sort of put there as the headline number of 1 billion. So there's some ins and outs, but it's largely rates and user charges. I'm looking at Rhona now to give me a wink on that one. Yeah.
Yep. But you know, if you had put in the crazy stuff, you could have got it really down. You could have made councillor.
I've got many ways to.
So I think that's the difference, though, that Tim, that Sarah's been alluding to, right? Is, you know, we have capital revenue from Waka Kotahi, NZTA, from our sludge funding that funds our capital program. It doesn't fund our operating expenses, yet through the profit and loss we have to record it as revenue. So we take that out when we're talking about the debt to revenue ratio, the same way when we do in our long-term plan or annual plan as well.
And this is a benchmark prudence measure, so there's a scripted formula for what we can keep in and take out. The accountant said so.
Okay, is that Councillor Foon? I'm a Deputy Mayor Foon, sorry. Apologies.
Yeah, just a few more days.
Deputy Mayor Foon.
Just with our capital underspends, I guess when we're charging essentially for rates, so how do we offset, or how do we speak to that to that situation?
I'll just talk to that one. So it's funded via rates through depreciation. And if we don't spend the capital program in a certain year, then our depreciation expense is updated down the line to show that we're not going to be, the asset hasn't been capitalised at the rate that we had previously budgeted. So it's kind of updated throughout an annual plan process where we know we've carried budget forward for certain capital projects, and that's kind of reflected and updated then.
Yeah.
But it's never an exact science, the timing and things like that. Yeah, but because we don't fund capital expenditure directly through rates, it's through the depreciation proxy.
Yep.
It's kind of,
Works out.
we adjust as we go.
Thank you.
Okay, so I'll put myself on the list. So a couple of things. While we're on that particular slide there, the 225% limit for 2024-25, now that limit was also changed in the long-term plan amendment in the subsequent year, and I'm not sure what the rule is about talking about future stuff, because you sort of talked about the local water done well, but during this year it wasn't really. It was really more this year that's mattering than last year. But in terms of the 225, I was wondering if there was a note could be added or something like that. Is that not part of the way that the annual report is done about this limit changing from year to year?
So there will be a step change next year to 200%. So absolutely, this is retrospective, looking backwards at the year that has just come. So we will, going forward, it will be the 200% as confirmed through the LGF. Too many acronyms, through the long-term plan amendment. The other thing that is being removed, again, I'm looking at Rhino, is the insurance headroom mechanism that's included in the 225 here, which won't be carried forward into 200%. In terms of whether we have to retrospectively, Dean will take over.
Yeah, we do actually make a comment in the financial prudence section that due to the amendment of the 24 to 34 LTP, that those figures will be incorporated next year. So we do actually make a comment about it.
Yeah, so I just want to be clear, because I understood that during that year the rule wasn't that the limit was 225%. The rule was the limit was 225% minus $272 million for the insurance debt headroom, and that was the actual limit. And could that be reflected in the report? That's the policy.
When this is a benchmark setting, again, there's a scripted calculation that sits behind this, and the 272 million previous headroom is removed for the purposes of this calculation when we're comparing it on a year-for-year, like-for-like basis, as you can see here.
So different to what we've published in the long-term plan in terms of that line.
Can I ask why is it removed? Because the policy is 225% minus 272 million. That is the limit.
For the purposes of this calculation and what we have to disclose in the annual report, this is the calculation that we have to show.
For the report, to comply with the reporting standards, which is basically what we have to do through this document. I'm looking to the
We don't have those same standards when we do the long-term plan or annual plan, when we're looking at the financial strategy debt to revenue limit.
Oh, okay, can we just take it offline? I just want to understand where the 272 million of insurance debt headroom is considered within the annual report.
We can take that offline, Tony.
Yeah, I just want you to show me where it is.
I've got my debt calculator guru online, and she'll be able to give us an update at some stage.
Yeah, it's not so much what is there. I just want to know where in the report it's reported. Okay. Is there any? So Bruce, I'm not sure if you're an expert in this area. I'm not sure if there's anything that springs to mind with respect to you, or should we go on to continue with the last of the slides?
Look, thank you, Tony. I'm actually reasonably comfortable, partly because I guess I'm familiar with technical standards in the reporting. I'm impressed with the thoroughness, but I am interested in hearing actually all of your questions, because actually we're doing the right thing, which is trying to interpret the information. I was particularly interested, Tony, what it's worth, but I found the notes that actually describe it well, which is why we had such a devaluation in terms of our roading assets. But I understand, the base of it from the information's here. So the information's here. I guess we have a technical understanding, but I do appreciate the challenge if there is a need for interpreting it, which is in lots of ways many of the questions we've got. So it's good. I'm all good, thank you. Okay. Happy if we carry on.
That's great. And so is there anyone else? So you've got. Sorry, yes, of course. You said you had another 40. So please, Councillor Young, continue.
So when we have a trust that we administer, like for example, we had the Joe Aspel one, which we managed to flick off to the NECAR. Do we take any of the costs of administration from the proceeds?
No, effectively, like Joe Aspel, as you mentioned, like the costs that we incurred of running and doing the work, we basically, the council bore those costs. We didn't pass them on.
Yeah, and that applies to all of. I mean, I knew that's with the Joe Aspel one, which is why I was keen to get rid of it.
Yeah, I guess there is one. I'm trying to remember, which is managed by. The Charles Plummer one, but that's not managed by council. That's the biggest one.
Yeah.
That's managed by the public trust, and so we just don't bear the same sort of level of cost there.
Okay, thank you. So the next question is, why would land under a reservoir have any value?
We do, it's just all the land we hold.
I mean, how do you value it? Because you can't build on it.
No, so I'd have to get right into the things, but what they do is
Yeah, but I mean, you can build on the land under my house. You can't build on it. Officer Brown, I'd just like to talk to the real officers.
Thank you. Yes, me too.
I think the way they've done it is they look at the land in that surrounding area. It doesn't matter actually what is on it, it does have a value, and they've looked at the land surrounding that to come to a judgment, an assessment of it.
And do we pay rates on it as well?
I would have to double check, but I would think so.
Good question, though.
So then of course, tied into that, so for example, so the zoo, we have a valuation for the land the zoo is on, but it's town built, so it can't be used for anything really other than, if we didn't have the zoo, that would be trees. So it's got no value really, has it?
I'd have to come back to check if that land is included in that infrastructure land.
And could you just check on the rates as well? And then last, penultimate actually, when will the leaky houses debacle come to an end? I mean, surely people know by now they've got a leaky house. You can tell by looking at stuff it's going to be leaky.
When it stops raining.
I think that will be probably a more appropriate question for our legal team. I can't answer
Okay,
that
I'll
one,
say it
sorry.
then. So then this is the last one. You talked about the structural defect claim. Is that the BNZ building?
Yes, that's the one.
Okay, thank you.
Last question to Councillor Brown.
Lucky old me. Just a question actually about the road valuation and also about the valuation of the pipes. Do we use optimised depreciation? So it is optimised?
Yes.
So it's not just...
Yep, ODRC. Yep.
Okay, so I'm just conscious, I mean, we started a little bit late, so we've got 2 or 3 more minutes. If you just want to get through the last of the slides, I would appreciate it, because I like to be complete in terms of the workshop. Thank you very much, Karina.
There was only one slide to go through, which was around the benchmarks, which we had touched on. There's effectively 11 benchmarks that we report on, and it's driven from the legislation. So there is a specific act that talks about how you calculate these benchmarks, and so we spend quite a lot of time making sure that we include and exclude the right things. Out of the 11 benchmarks, 9 were met. So that's higher than last year. I think it was 7 last year. And the 2 measures where we didn't meet the benchmark or the target were around the rates affordability benchmarks, which have been signalled previously. So there was no real surprises in that section.
So that's it. So, look, thank you very much. I've got one last question. We've talked a lot about valuations and asset valuations. My general question is, when you come to look through this and working with the LT and the other teams, are we talking about hours and hours of work actually going through all this that's actually behind these figures?
So in the valuations, because we've have the external, we can put a lot of reliance on their reports, but to get to those reports, there is a team that does spend hours and hours reviewing the data inputs
Right.
to get to that point.
Yeah.
Yeah.
So thank you very, very much for your work, and thank you for bringing us through this report and what happened in 2024-25. So I look forward to the final report in the Audit and Risk Committee. Thank you very much.